My name's Eli Delaney, and I have the honor of meeting some pretty cool people. These are the entrepreneurs, the artists, the creatives, the game changers that are making a positive impact in the people that they meet. And I'm a firm believer that the people that you meet can get you anywhere you want to go. And this show is my way of sharing them with you. It's my way of also helping you meet cool people. All right. You have heard the phrase, it's not how much money you make, but how much you keep, right? So, with that said, I'm going to share today's guest with you because he's got some pretty cool stuff you definitely want to be ready and take some notes with. I'm Eli Delaney. We are here for another episode of the Meet Cool People Show. And today's guest is Michael Hession. He was 16 years in his own business in the marine industry when he realized he was getting burned out. There wasn't an exit strategy in place. And then he found something cool, something by the name of infinite banking. And he has been helping individuals and business owners create lasting wealth through infinite banking. And he's teaching individuals like you how to keep their hard earned cash outside of credit cards and bank loans and all those different things. Keep that money, use that money over and over again, and you get to keep more of it at the end of the day, which is the whole point of everything that we earn. So, with that said, Michael, thank you so much for joining me today.
My pleasure. Good to see you, Eli. How are you?
I'm doing awesome. I am so excited about this call because you and I have had a couple of conversations about this stuff, and it just amazes me how many people have never heard of infinite banking. So, out of the gate, kind of give us the clue of what a big picture overview. What is infinite banking?
Sure. Yeah, it's funny because it can seem kind of complicated, but in the simplest form, it's the idea of taking the banking equation and putting it into your own favor instead of it where it exists now, which is through the banks and various lenders, mortgage companies, that kind of thing. Nelson Nash called his book is called Becoming Your Own Banker, and that's the idea that that piece of the puzzle where money flows into and flows out of, for most of us, it's out of our hands a lot, and this is just a way to have it in much more in our control through a very particular type of life insurance contract that's been around for a long, long time. So it's simple, putting the banking equation as much of it as you can in your favor and under your control.
Awesome. And so, how did you find out about infinite banking? Let's kind of start with that. Where did you come up with that concept and how did you get involved?
About 11 years ago, I had a business years ago myself, and then I kind of burned out and got out of that. But then eventually, I learned about things like leverage and real estate. My wife and I were real estate investors before 2008 happened, but I had also learned how to trade in the markets. I was doing options trading and that kind of thing, and reading the Kiyosaki books, Rich Dad, Poor Dad, and things like that. So I started to see, well, there's this thing called leverage, and to get ahead, you have to have some form of leverage in your financial life. And eventually, I went to work for a life insurance company, and it was finance related, but it wasn't tied to the stock market because through my trading, I I just lost the flavor and taste for being. In my case, I had my own money and other people's money that I was trading in the markets, and it was kind of exciting and kind of scary, and I just kind of lost a taste for it. And going into life insurance, that was sort of the reason. It was finance related. I could help people out, but once I get into it, I didn't had no notion that you could build wealth vehicles out of a life insurance contract. So that was the sort of early, germination of understanding that. And then a couple of years into that career, I learned about infinite banking from a gentleman who my wife knew through her work. And that was in 2014, about 10 years ago. So I first learned about, this life insurance as this sort of wealth creation, tax-free wealth creating vehicle, and but then more specifically infinite banking and the right kind of policies, the right kind of companies, and just the power that it provides for people. And there's a little bit of like stick it to the man to me, We all know that the banks run, the government has, all these institutions kind of run the show. But if we can sort of do something about that, why not? You know.
Mhm. So I'm going to back up a little bit here because you're talking about creating using your life insurance as a wealth creation vehicle. You shared with me a great story about a big name everybody's heard of that actually used it's a great example from a big picture standpoint of how this process came to be. So share with me how Disney used infinite banking to get ahead.
Yeah, it's a great story. It's another thing about these life insurance contracts. They've been around for a long time. Some of the companies I use are 100 and almost 180 years old. They've been around for a while. They actually predate the creation of the IRS and tax code, the current tax code, in many cases. And Walt Disney wouldn't have used the term infinite banking. That was, Nelson Nash created that terminology about 20, 25 years ago. And but it was very common for people to use whole life insurance policies as a place to store and grow their wealth. And what Walt did was he had his film studio and he wanted to start his first theme park. And the banks were like, go screw. We need more collateral, we need more, down payment or whatever. And he realized that he had enough cash, that was called cash value, in his policy. I don't know if it was one policy or multiple policies, that he could use that cash out of his whole life policy to help start his first theme park. So just a great example of someone, back in the day. This is probably, I'm not sure when probably in the 50s, maybe, that he did the first theme park. But, Ray Kroc of McDonald's fame did the same thing. He tapped into his policy's cash value. And when you do tap into those, there's no questions asked. You're not going begging to the bank and hoping that they'll lend you some money. Whatever's available in your contracts, you own the contract. You are able to tap into whatever's in there and available. Uh, what's the woman who started the Pampered Chef? Same thing. She started that. I can't. Doris Christopher, I believe, is her name. So it's and J.C. Penney used it for payroll back during the Depression. He pulled money out of his policies to help, pay for people in a really bad time. So it just, people forget that stuff. It's just been around for a long time.
Well, and I think that the reason that I got so excited about the concept of this was because so many people don't realize this is something that they can use against. So, as
Mhm.
an example, let's break it down into some of the basic ideas. Like we're talking about some big names here. They basically took a life insurance policy and it was specifically designed. This is what you do and you help people with, and
Mhm.
basically said, okay, let's say this particular policy is worth 100 grand. They borrowed that 100 grand against the policy in
Mhm.
order to basically, buy the park, or start the business or whatever. They've done these things. And
Mhm.
what that ends up being is at the end of the day, this is why you explaining it to me was so critical, was it's like, but at the end of the day, I'm not paying back a loan to somebody else. I'm paying myself back.
Yes and no. Technically, you are paying a loan back to the insurance company,
Okay.
but it just goes back into your cash value to be used again.
Mm-hmm.
So that's so. And the thing is, when you create these, it's a growing asset that has guaranteed growth inside of them. When you include dividends, these companies are all what are called participating whole life policies, and they declare dividends, which are never guaranteed, but it helps the whole thing grow. And we use that to buy more life insurance, which keeps it all tax. This is all tax free, by the way, because these are treated unlike 401ks and government retirement programs. These are treated with after tax dollars, and if you set them up right, the growth inside of them and access to that growth is all tax free. So so even when you take loans out of your available cash value to do whatever you want with it, it's going to keep growing as if nothing came out, because nothing actually came out of the cash value. It's collateralized by what's in your cash value, and the company just lends you out of their general pool of money. So and the idea with infinite banking is that you want to pay it back because you're going to need those dollars again for something else. That's the whole idea of it is you start to act like a banker where you have money, you put it to work for whatever. A lot of my clients to do it to go after debt, but they don't just pay off the debt, they actually buy it because then the money that was going to outside lenders for car loans or credit card, whatever, you cycle it back in, pay it back to the insurance company, but you benefit from it because it just goes right back into your cash value to be used again for whatever you need the next time around, the next car, the next debt, whatever that happens to be. No questions asked. You know.
So let me clarify this a little bit because I love the way this simplifies everything down. Let's say I need a new car. Maybe it's for my business. Okay, I'm getting a new car for the business. I can go to the dealer and they're going to work out some deals, and they might even come back to me with a 0% loan.
Mhm.
But at the end of the day, I'm paying that, say $500 a month payment. And even at zero interest, it's gone. It goes to them.
Yep.
It's done, right?
Yep.
But using a policy this way, I'm basically borrowing against the policy. So I'm borrowing it from myself. I say my business is borrowing from myself. We'll
Mhm.
call it that.
Yep.
And then they turn around, and when I make the payment, I can make the exact same payment. So let's say $500 a month,
Mhm.
but then I put it back into the policy as opposed to paying a bank back.
Right.
So at the end of the day, when that loan is paid off, how much of that money do I get back?
It all comes back. And then more, because remember that cash value is constantly growing. Usually it's around 3%. I didn't
Right.
finish my thought earlier. When you add in the dividends, over time, these things typically anywhere in the 6, 7, 8% growth rate inside of the cash value over time. And then if you start with younger people, 20, 30 years down the road, the compounding growth inside of these things is really off the charts. It's sort of a short term cash flow vehicle and with long term, like really remarkable growth because of the way they're designed and the guarantees inside of them. So yeah, that's exactly what it is. I think I told you I have a client who she had a hard time getting her head wrapped around it because she had a vehicle that $350 a month but it was just zero interest. I go, great, but you're still giving them $350 a month. She had cash value in her policy. A year before, she had tapped it into that cash value to buy more crypto. She's a crypto investor. And then she paid it back. So she, put that money out of the safe asset, the policy, bought the speculative thing, the crypto, more crypto because she feels like it was at the bottom. It's actually looking like it's starting to work out in her favor now. Some of
Mm-hmm.
those crypto markets are starting to really, ramp up again. And then had this car, and I said, "Look, you're never going to see that 350 a month again, regardless of the interest rate. It's not like you can sell that car and make out on it. It doesn't happen with cars. You lose the value
Right.
right as soon as you drive it off the lot." So she's doing that. She just paid off the vehicle, and yeah, like you said, you could pick the same number. Nelson Nash would have. He teaches do more. If you can afford to do a 500 a month, cycle it back into your system. And
Right.
I also have a way where I can show because there can be a time where if you pay the loans back, there's no more room in the policy. So I teach people. My mentor taught me a way to have a system becomes a system of usually a system of policies because once you start doing it, you often need more than one. You start with one, but eventually, as you really start to do this, it becomes a series of policies. My wife and I have several. I have a couple of my daughters, and so you allow for this money just cycling back into your system. And I don't know if I've told you this, but a great way to think about it is we all have our own economies. If you think about it, there's the broader economy, there's the global economy, but really we all have our own economic systems. Money coming in, money going out, and if we can start to have more control over that through infinite banking, it's such a peace of mind. I don't care what the stock market does. I know
Right.
that our money is in there growing regardless of what the stock market does. And so it's really a peace of mind kind of a thing. And you have to be willing to take it on. It's not for everybody. There are people who would rather just give their money to a financial advisor and hope for the best and pay fees. and pray for their the market to keep doing, maybe going up, maybe going down. So this is not that. This is really people who want to take control and be in charge of what's going
That's
on.
great. Now,
Well,
you said something that brought up a good question is who, like, the basics of I can get a policy for myself, but you talk about, your wife has one, and your kids. So who can you, can you have a policy for?
it's so that comes into the so in the case of my daughters interest, you have to be able there has to be some reason why you're purchasing a policy and owning it and funding it. So in the case of my daughters, I'm funding them. They're both my one daughter was a minor still when I started, so we were naturally the owners because she was under 18. But my older daughter's case, we fund it, and she started out as the owner, and then we changed it. So we now own it and fund it. Eventually, I'll hand it over to them. Once I want to fully fund them a bit more, and then also I want to make sure they understand what these things are. We've had some conversations, but they haven't really taken it on yet. So I will not hand ownership. It's very easy to change ownership. You just fill out a form. So grandparents can fund policies on their grandchildren. You usually in that case the parents will own it, but the grandparents can certainly fund it. And if you start getting these policies on young children, just the benefit to them, it becomes this whole intergenerational thing. It can be used for college funding. It can be used, once a kid gets older, you can hand ownership to them. They get married, they can change beneficiaries, they can do all kinds of things with it. So that's another really just a lovely thing about it, just intergenerational component to it. And it's all between yourself and a private financial company rather than government mandates and that kind of thing and stock
Right.
market related. So, yeah.
Right. Now, correct me if I'm wrong, because I think I heard this from somebody else. A lot of times, like even bigger companies, corporations, a lot of times have actually got these kind of policies on their higher level employees, don't they? In that, like Walmart, different companies like
Oh,
that
yeah.
would do that. Yeah.
Yeah, they do. It's just slightly different in that, and this is interesting. I don't have the numbers in front of me, but big banks have, and especially the publicly traded banks, is a way you can find, Bank of America, Wells Fargo. They own a ton of permanent life, whole life, and these other types of permanent policies on their key people. Their VPs and presidents all across their business. You think about a Bank of America, that's a lot of people. So in that case, they don't necessarily use it for cash flow purposes. It's more a safe place to keep their money. So these are banks dumping billions of dollars into premiums on their key people, and it's in large part because it's a safer place to keep their money there than in their own banks. And that sounds crazy, but it's true. These life insurance contracts, companies have much more stringent requirements on what they have in reserve because of the way they operate. The banks
Right.
they're over leveraged, so yeah, they do. They don't necessarily infinite bank with them, but it's like a safe place to put their money and a death benefit play. So they know, like, it's like an intergenerational thing for the banks. They know that money will come back to them. You know, so
Right.
but they do that a lot. Yeah.
And that actually opens up another question for me. You just mentioned that it's also a death benefit. A lot of times people think of life insurance as more of a death benefit type of situation.
Yeah.
This, correct me if I'm wrong on this, but you kind of look at this differently. Yes, it has that component to it, but you don't look at it as that. You look at it as a asset that you can then turn around and basically kind of like your own piggy bank that you can then borrow and put money back into,
Mhm.
knowing that at the end of the day, yes, there is that in there, but the negative is literally if something happens and you had borrowed against it, that just means whoever the beneficiary gets less money,
Mhm.
right? That's pretty
Yep.
much how it works.
Yeah, and if there's outstanding loans, they just subtract it from the death benefit.
Right.
So for the life insurance companies, it's an extraordinarily safe type of loan to make because they're on the hook for the death benefit at some point anyway. So they're fine with it. Not all companies do, but so there are probably a dozen or so, and they're what they're called participating mutual life insurance companies. So they're not publicly traded. It's another piece of the equation. These are mutual life insurance companies that have no shareholders and have no stock price. So they don't have. You can never have a situation like with Elon Musk and uh, was it Twitter, right? Where he
Mhm.
owned enough shares of it where he could sort of dictate where the company's going to go. It can't happen in these mutual life insurance companies because even like a big giant bank might own billions of dollars of policies through a company. It's not like they can then wield their power and influence. It doesn't work that way. And because there's no share price to worry about. It's not even an issue. So that's another important piece of it as well. And
Nice.
so yeah, that's the death benefit's important though, and part of the reason is I'm not sure if I mentioned this to you, but the IRS years ago in the 80s, some changes were made. The last time the tax code was changed by Reagan, it changed a lot of a certain type of real estate investing that wealthy people were doing. And it was suggested to them from their advisors, a lot of them, to dump their money into single premium whole life insurance contracts. They get a big death benefit and access to cash, all tax free. It didn't take the IRS long to catch on to it, and they made some changes. And I think that sort of forced some. That was like in the mid '80s, so it kind of forced the companies to, and even the insurance companies, they'll focus on the protection and the death benefit. It's almost like they don't want to make the IRS mad and get them too upset with them. So they sort of do this delicate dance, and they focus on the death benefit, and it's not as important, but it is a piece of it. It's an important piece of it, but it's not the main part of it. Does that make sense?
Yeah, definitely. And I mean, it's good to know kind of where that's coming from because, again, so many people are used to, a life insurance policy with the idea of the death benefit side.
Yeah.
Um, and this is a totally different creature. I mean, yes, it has the same components, but it is a very different creature and it serves a very different purpose. And I think that's
Yeah.
where I love talking about this. And you and I have been able to have a couple of these cool conversations because once it clicked for me, I was like, okay, I don't understand why I didn't get this and why more people don't know what this is,
Mhm.
because it wasn't until maybe 10, 12 years ago that I had ever heard of it. But it wasn't until just a couple of years ago that I actually understood what it
Mhm.
really stood for.
Yeah.
And that's why to me I think it's so powerful.
Yeah, it is. It's just it clicks for you different times, and and the industry, everything's geared towards the stock market. I mean, even the first life insurance company I started with, I was strongly encouraged to get my securities license because that's where you make your money. You get your securities license so you can handle money, 401ks, and that kind of stuff. Because there are all these companies that are forced to provide these things, and starting back in probably in the '70s. So the focus became, get your securities license and manage money. Take a million here and stick it in some funds and earn your fees. So that's what they focus on. They've forgotten that you can do this with these life insurance contracts. And since it kind of goes against what they teach, there's almost like a resistance to it from a lot of people in the financial world I've found. And I know some of them because that's not
Yeah.
what they're taught. They're taught, no, you got to be in the market. Oh, average rates of return, blah, blah, blah. And so that's part of the reason. It's just a kind of a combination of reasons why people don't know about it. And it's just,
Right.
myself and other practitioners, our job to try to just get as much good quality information out there as possible so people know they have some options.
Got it. So we've talked a lot about this and we use some bigger examples of companies that are using this or corporations that we've all heard of, bigger companies like Walmart and Disney and stuff like that. But this is something I want to really push the fact that this is something that we all have access to. And we use the example of, say, a car loan, but it could be a car loan, it could be a computer. Great example. My phone's starting to cause issues with me, and I went shopping for a phone the other day, and I'm like, it's a better deal for me to basically loan the money to myself and buy the phone flat out than
Mhm.
pay what 20% interest on the lease of the phone with the phone company, right?
What do phones cost? Like a couple $1,000 now?
Oh
or
yeah, depending on if you want the latest greatest, you're talking at about probably 12, 1,500 bucks easy.
yeah, yeah.
And so those are the kind of things we can think about. It's like these are things, and again, it goes back to the fact that it doesn't matter what kind of deal they give you. You know, you could do, I mean, this phone that I have right here was I bought it off of Amazon. I had a 6 month no interest off of my Amazon card when I bought it. That all
Mhm.
seems cool. As long as I pay it off in 6 months, we're all honky dory. But the
Yep,
difference is that money going out every month, it's gone. It's like poof,
yep.
gone. We're doing this if you loan it to yourself using your infinite banking policy.
Mhm.
Now you just make the same payment back
Mhm.
and you get all your money back and you can reuse that again.
Yep, do the
I'm
same
really
over and
pushing
over.
that because I want people to understand how so simple it really is, honestly.
It is. It really is. It's just no one thinks about it, so they
Yeah.
don't.
Yeah.
And
Well,
another thing too, a lot of people, people out there who are listening, they might think, really get caught up on cash. Paying cash is the same thing. Nelson had this great, I'll paraphrase it. We've in life we finance everything that we buy in one way or another. I mean, some people still barter, but it's pretty rare. So we usually we save up and pay cash for it, or we'll we'll get we'll take a loan out to get it. Like in the case of the phone you mentioned, um, that given that even with cash, it sounds noble and everything, and there are people out there espousing it, and and poo-pooing whole life insurance because Dave Ramsey, I'm not afraid to say his name. He just doesn't know what he's talking about or hasn't taken the time to understand what this is. Even when you pay cash, that money's gone. You're never to be seen again. If you look at most of the people, the wealthy people, a lot of them they borrow money to get the stuff they need. The Warren Buffetts of the world. Now, people like that, they have enough standing where they can get banks to lend them money. Most of us, it's harder. So this is a way to just to redirect your cash flow where you earn your paycheck from, whatever it is, and just put it in. And again, Nelson would say this is the opposite of life insurance, where most people pay the least amount for the biggest death benefit. We completely switch that. Put as much as you can into it in premium and for a lower death benefit and go from there and then just self finance as much as you can. And you can't, it's not like you can really cut out the banks completely. Although I know people who are close, they've been doing it long enough where they can pretty much self fund everything. But the main thing is just a lot of my clients they'll go after debt. Like I said, just outflow of money. There's this the stats are it's like 34 cents of every dollar in the U.S. is lost to interest. Every dollar spent. That's a lot. On average. Of every and more than 70% of that is or they only get to keep about 70 less than
right.
70% of it, and it's
Yeah.
just hard to get ahead that way. So
Yeah. Now, this is really good stuff. So, people are going to obviously, we talked about the big picture, we talked about the smaller picture. If somebody's interested in getting going with this, what kind of investment are they looking at to kind of get started with this process?
that's a great question. It's I would say my clients I usually like to think in terms of annual premium, and ideally because rather than monthly, which is also different than what most people think about when they think of life insurance. Usually they just set up some sort of monthly payment. So this is ideally you want to think annually. I talked about this. An adult, say someone 25 or so and up, who's making some money, 10,000 per year, which is less than 1,000 per month if you factor it out that way, is about what you want to get started. If it's below that and it can be a little, you can do a little. That's not a hard and fast number. That's sort of a general guideline for adults. For children, I have quite a few that are less than that. They might be five, six, $7,000 a year in premium. So that's sort of towards the lower end, and then up from there, depending on what your income's like and what your cash flow is like. So it's if you think of it that way, it's not it's doable. I have plenty of
Right.
people who have $10,000 ones, and the woman I mentioned earlier with the cars is fairly. the modest $10,000 premium policy. She's bought crypto with it, and she bought her car, and with a fairly small, not a real big premium policy. So
Right. No, that's good. It's a good way to kind of so people have a clue of where it is they're going with that, and what they need. Because that's one thing with this kind of stuff is like, okay, this sounds cool, but if all the rich guys are using this, it's probably out of reach for me. Well, if you can put the concept of 10K a year down, you can get started with that. Obviously, more would do better,
yeah.
but that's something that could get you going. So I love that you could explain that for people. So, is there anything else related to this that we missed that we should go through? I think we had a pretty good conversation, but I want to make sure that there isn't anything else that you feel that we need to talk about that explains it any better.
Um, Let me think. Yeah, it's simple, but there's a lot to it. Just because, and that's why Nelson called it infinite banking. Because once you start to do that, and you start to take on the role of being your banker, and he liked to call it banker. We get in some trouble, but the insurance companies don't like us to call them banks because they're not banks technically, right?
Right.
Because they have compliance issues and that kind of thing.
Right.
So, but once you start to wear that hat and practice that muscle, what you do with it is it's completely up to you. Because like when I call those companies and I need a loan from my one of my policies, it's never what's it for? What's your credit score? It's whatever's available in there. We'll send you a check, or usually do electronic transfer within 2 or 3 days, and so it's a pretty quick turnaround. Yeah, I just encourage people to look into it. It's really an extraordinary thing, and it's it's simple, and it's just looking at it different. And no one is taught how to work with money. Most people aren't. And so I think that's part of what happens is anything finance related, just their eyes glaze over because no one ever taught them anything about it, right? Just educate. Don't be afraid to take it on and educate. It's a process. I have a very particular process I take people through to see, like, do you have some money sitting in savings somewhere, just doing nothing? Well, maybe we can use that to get you started. Or maybe you have some grandparents or someone who's got a chunk of money they've got set aside for you or your kids that's sitting in a savings bank earning, savings account earning next to nothing. We look and see if we can find uncovered money to get started and just go from there. And so I think we've covered the basics for sure.
Awesome. Love it. All right. So I'm going to have two questions for you. Two final questions, I should say. Now,
Okay.
this is the Meet Cool People show.
Mhm.
So I'd love to hear, what does Meet Cool People mean to you?
Um, well, obviously, it's your phrase, which I love, and we've known each other for I don't know since last summer, I guess, or no, about a year, about a little over a year, and I just think it's just a great opportunity to connect with people who are up to cool stuff. You know, they're up to things. They're not just at least that's been my experience with the people that work with you, and I've been working with you for about not quite a year now, and it's just a great platform for cool people who are up to stuff, and they're glass half full people rather than glass half empty. Does that make sense? That's kind of how I see it.
I
Uh,
love it. That is awesome. I appreciate that. I
yeah.
always like to ask people what that means, and it's not a matter of what is it. What does my Meet Cool People mean to you, but what is Meet Cool People in general? And I love hearing everybody's answers with that because it always goes back to that. You just said something I personally love, which is it's glasses half full people. I love that. I appreciate that. All right. So with that said, let's go ahead and land this thing. People are going to want to learn more about you. So, what is the best way for them to get a hold of you?
Well, probably the freebie that we have called the Perfect Asset, and it's a just a checklist and just a great way to just read a little bit about it, and then you can book a call through that. It's a great way to start. Theperfectasset.net is
Awesome. I
the
love it. And again, that to repeat that is the perfect asset, and it is theperfectasset.net.
Yep.
And it's a great starting guide. I was able to go through it. I helped kind of proof through a bunch of stuff with it to begin with.
Mhm.
And if you're interested in this stuff, that is the first step, because it's going to give you some ideas of things that we didn't talk about today. And then obviously, if they read it, they like it, they want to hear more, they can book a call with you. Correct?
Yeah, yeah, and
Awesome.
that name, that wording is the perfect asset is for a reason. I
Yes.
really think these things are just a great, perfect foundational asset that a lot of people can tap into, and
Very,
then go from there as a foundational piece.
yeah.
So
Very cool. I love it. Awesome. All right. Well, let's go ahead and wrap this thing up. Michael, thank you so much for coming and hanging out with me today. This has been an amazing interview. I have been very much looking forward to this, because I knew you and I were going to talk about a bunch of cool stuff that so many people just need to know about. So
yeah,
thank you for
awesome.
coming and hanging out with me.
My pleasure, Eli. Thank you so much.
All right. And for everybody else, get out there, have an amazing day. You know how to get a hold of me if you need anything. Have an amazing rest of the week, and we'll talk to you later. And that wraps up another Meet Cool People show. Now, if you like what you heard, be sure to give us a like, subscribe, or review so I can help introduce these amazing cool people to even more amazing cool people. And just remember, meeting cool people is just the beginning. You need to have a system in place to follow up with the amazing people that you meet. This is exactly what we do for our clients. If you'd like to see if my team and I can help you, go to followuprockstar.com and check out the case study video to see exactly how we're helping our clients turn casual connections into cash clients for life. Again, go to followuprockstar.com and we'll see how we can work together to turn you into a follow-up rockstar.